Good morning from our global headquarters in New York. I'm Manus Cranny. It's Bloomberg Brief. Let's set your agenda. Marching on, stocks on track for a fourth straight month of gains as investors await the latest inflation data. A time of deep reflection at Intel. Chipmaker mulls splitting the business and scrapping projects to navigate through a historic slump. And Sunbelt's up for grabs. VP Harris edges over former President Trump in the swing states. More on the latest poll coming up. Breaking news for you on the euro area prices. This is about inflation in the Eurozone. 2.2% year on year. The estimate was 2.2%, so that's on the headline. Very much in line with the estimates, bang in line on the core. 2.8 versus 2.8. I can tell you French inflation is the lowest in 3 years. German inflation dipped down to just over 2% from 2.7%. So this inflation narrative, disinflation narrative, I should say, in the Eurozone is certainly in train. There is the euro dollar at the moment, is the dollar that has had a pretty tortured month against the yen, against the euro, all the way around. 110.77. Let me just show you what's going on with the markets. Do you believe it's the roaring 20s? Torsten Slok thinks it is. The slippage yesterday was on Nvidia, of course. It skidded by 6%, the worst day in 4 weeks. You look at it this morning, it's up 1.5%. So the narrative about whether the rest of Mag 7 can hold up and a rotation can take place. That's what Franklin Templeton are saying. I like their line. Industrials and energy don't need a moonshot to be good. And SocGen are looking at breadth. Rest of the market, bonds marching for the fourth month higher, up 1.5% on the month. Bostic, you know, again, a reticence in Raphael Bostic. We're far from the Fed's 2% inflation target. And dollar yen, keep an eye on that. We are, again, looking at Tokyo inflation topping out estimates at 2.4%, laying the roadwork for another rate hike from the Bank of Japan. So we've had strong GDP data, a strong reading from the United States of America. Today, it is about inflation data. My guest is Kallum Pickering. We're going to come back to Kallum in just a few moments. And if we think about the theatre of what we had yesterday, we had GDP revised higher, we had a PC, core PC coming in better than we had estimated, and jobless claims pretty reasonably in line. So the question that we need to ask ourselves today when we look at that monthly PCE is the disinflation data and how that comes through. There's the S&P 500 at the moment up 0.4%. And if we just go back to the narrative in the equity markets, again, Franklin Templeton would make this argument that there is a rotation. In other words, there was breadth to play for yesterday. You saw that revision on the GDP to 3%. And just to refresh your mind about what SocGen say, the narrow bubble trade is going to broaden and the breadth will continue. As I say, we're settling in, we're reflecting on yesterday's GDP data. We have Kallum Pickering, the chief economist over at Peel Hunt, and he weighs in on the Fed writing this. To prevent the ongoing US slowdown and turning it into a genuine economic deterioration, the Fed will probably be more aggressive of the three central banks. He joins me now. Kallum, what does it take to get them aggressive and punching out a 50 basis point cut in September? Good morning.
Well, good morning. I think 50 basis points would be very aggressive. You saw the latest US GDP data for Q2 revised up again. The PCE data today will show inflation above 2%. This is not an environment for a 50 basis point cut, but aggressive would probably mean 25 basis point cuts without skipping for the 3 meetings remaining this year and then probably for the first 4 of next year. My hunch is the US economy is going to start to slow pretty appreciably into Q4 and then into the first half of next year. That usually would be something that markets might fret about, but I think the combination of lower interest rates, further declines in inflation, and actually the realization that it's just a slowdown, it's not a hard landing, will be good for risk on. And my hunch is actually that risk on won't just be in the US, it will be outside of the US. Of course, with the caveat, let's see what happens with the US election.
What does pretty appreciably mean and look like in a slowdown?
So Q2, 3% annualized, that's a huge number. The Fed thinks the sustainable rate in the US is 1.8%. So you would expect after almost 2 years of above trend growth to see a slowdown in any case. My bet would be we'll be sub 1% annualized by the turn of the year. And the forward-looking indicators on the US by now are consistent with that. I'm paying close attention to the labor market data, not because I'm very worried about a recession, but it looks as if, at least on consumer credit for a while, US consumers have tapped out. There's very little in terms of excess savings that can be spent. So the thing that's driving US domestic demand now is employment gains and real income growth. So if employment gains really start to slow, that would show up almost immediately in consumption, and then that would show up as weakness as broader US momentum.
So if a growth drops to sub 1%, as you say, it's not going to be a shallow and short cutting cycle, is it?
No, I would expect the Fed to take at least the top end of the funds rate probably to the mid-threes. My bet would be around 3.75, which is actually probably a little below the neutral interest rate in the US. We discussed this last time. I think it's around 4%. So if the Fed can get to a situation where US monetary policy is neutral or slightly easy, I don't see the sorts of excesses across the US economy that would lead me to think we're due for a genuine cyclical correction. I think what you'll probably start to see is housing pick up, business investment to pick up. You'll still see a big fiscal impulse, and that slowdown will be short-lived, and through the middle of next year you'll start to see a stronger pickup. Of course, if you get a big surprise to the downside and you do get a technical recession, I would expect the US Fed just to slash interest rates, and then you would get a V-shaped recovery into the second half of next year. Either way, by this time next year, I think we'll be risk on. It's just what happens in the first half of the year and factoring in that election result.
I know that you're one of the economists that can channel risk, the risk narrative from the data. Bonds up for 4 months in a row, record highs in global equities. Europe's at a record high. Does risk march higher and onwards?
I think risk can go higher into the second half of next year, into the second half of this year, just as long as we don't get very serious downside surprises in US data. I'm a little bit nervous that the bond market is going too far. Simple way to think about bond yields, on a 10-year, it's a proxy for nominal GDP growth. So US fair value is probably around 4%. That's 2% inflation and 2% US real GDP growth. You can probably go a little bit lower in line with a slowdown in the US, but by next year, once we start to anticipate a stronger recovery, bond yields will start to tick a little bit higher. And so I think we're close to fair value pretty much across the Western world, with probably 20 to 30 bips variation either side, just depending on how monthly data meters.
Yeah, various people have said they're looking a bit rich. Let's look at your tail risks. Jake Sullivan's just on the plane back from China. It looks as if all doors were open for Jake Sullivan on that trip. Biggest tail risk as you look into 2025, will it be China?
China, I think, is a manageable problem. There's a long-term slowdown in growth potential, which is due to a host of factors, not least the aging population, but also the capital misallocation, the problems in the real estate sector. But I don't expect any significant growth slowdowns. I think they can hit that 3.5% to 4% range. The big risk for me is the US election. This is an event risk horizon that markets need to pay attention to. If it's Harris, there's one set of policies that we'll have to deal with. If it's Trump, it's a very different set of policies. It's very difficult for markets to kind of draw a Venn diagram and invest in the middle. And so what we'll see is the market wait until the election, find out who wins, judge what the Congress split is, whether it's a full sweep or whether it's a split, and then try and figure out what to do from there on. I think actually for markets, Harris is going to be easier near term, but then risks will creep in over time. Whereas with Trump, I think we'll be considering what the tail risks are immediately, and then after a little while, we'll probably better adjust.
And probably search social media on a daily basis for new risks as they arise. Kallum, thank you very much for being with me this morning. Kallum Pickering.
My pleasure, thank you.
From Peel Hunt. Always good to have you with us. Other stories trending on your Bloomberg terminal. This is what we got for you. Chinese real estate and consumption stocks surged in trading today after Bloomberg News reported that the country is considering allowing homeowners to refinance as much as $5.4 trillion in mortgages to lower the borrowing costs for millions of families. French inflation eased to the lowest level since July 2021. Cooling in the rate of price rises bolsters the case for the ECB to continue cutting interest rates after similar slowdowns in Germany and Spain. The euro area inflation, we've just broken that for you, 2.2% over the previous year. Meanwhile, the case for the Bank of Japan to buck the trend and hike rates has been strengthened after the latest Tokyo inflation print topped expectations. CPI, excluding fresh food, rose 2.4%, in the Japanese capital. Coming up, Intel rising in the pre-market as the chip maker weighs the options after a historic slump. We'll bring you the details. That's next. And consumer is alive and well. Spending is shifting. That's according to Janasiewicz of Natixis. He catches up with me later this hour. Context Matters on Bloomberg. Bloomberg Brief from Manishkrani in New York. Good morning to you. Shares of Intel are higher this morning. The chipmaker said it's exploring options to cope with the historic slump. Joining me now is Robert Lee, Senior Analyst for Bloomberg Intelligence. Good to have you with me. The question is, how does Pat Gelsinger stop the bleed at Intel? Because it is bleeding.
Yeah, I think Intel, for those who've covered the stock for the last 20 years or so, Intel's superbly positioned in the PC market and server market, which it dominates in terms of chip supply. However, those markets are in a very mature phase, they're ex-growth. So Intel, for at least the last 15 years or so, has been trying to diversify into other markets. It tried without much success to diversify into wireless and mobile. That didn't really work. And more recently, or the last 10 years or so, it's been trying its hand at foundry. But as you know, that's a sector dominated by the Taiwanese and TSMC in particular. So the foundry business has had some top-line growth, but it's losing $7 or so billion a year. So the unconfirmed report is that they're potentially looking to spin that business out to free up capital to invest in other potential growth areas. What they may be remains to be seen, but I would guess it probably would have something to do with AI.
Yeah, I mean, all roads lead back to that. You just look at Dell's numbers. I'm going to talk about those in a moment. In terms of cutting off a finger to save the arm and the body, what is that solution? Is that scrapping some capex, scrapping some projects, or is it the bigger option, which is, let's say, splitting the company up?
Okay, that's a very interesting one. I know we're limited on time, but Intel follows a very traditional model referred to as integrated device manufacturer. Effectively, it does everything. It designs the chips, it fabricates them, it packages and tests them, and then it sells them on. Whereas you look at companies like NVIDIA, they focus solely on the design stage. Everything else is outsourced. You look at TSMC, they do the fabrication or manufacture. So the move to the outsourcing model has been something that's driven the industry within 20 years, for the last 20 years or so. Yeah. Intel, is following a very traditional model. So perhaps one way forward for them is to try and, split the business up, to focus on where their core strength is, and obviously to tap in more to growth drivers, particularly in AI.
Yeah, well, certainly Gelsinger has got some pretty tough decisions to make. Robert, thank you so much for being with me. Let's just check in on the Dell price. She's trading higher this morning. They're reporting sales that topped estimates. I mean, revenue jumped by 9% to $25 billion. Orders for their AI servers, $3.2 billion. And the market was looking for 2.6. Just looking at the analysts are saying, you have got an impressive upside from Evercore and a strong set of metrics from Barclays with an equal weight on it. Evercore are outperforming. This is Bloomberg.
My agenda includes what we need to do to bring down the price of groceries. For example, dealing with an issue like price gouging. What we need to do to extend the child tax credit to help young families be able to take care of their children in their most formative years. What we need to do to bring down the cost of housing.
Vice President Kamala Harris there sharing her economic agenda on CNN last night. The former President Donald Trump, he has different plans if he wins.
The first thing I will do to make middle-class life dramatically more affordable is to end Kamala's war on American energy, terminate her Green New scam, and drill a baby drill. We're going to drill, baby, drill.
Well, polling carried out after last week's Democratic National Convention shows that Harris is edging ahead of her opponent in the key states that may swing the November vote. Enda Curran is with us from our team in Washington. Enda, Harris has this edge. It's in the Sun Belt states, and some of them quite considerable. What are the issues that she's pushing forward on and winning on and cutting through with?
Well, she's talking a lot, Manus, about the opportunity economy, this idea about tackling the economic issues that are hurting the middle class. And like you say, the latest Morning Consult Bloomberg News poll shows she is gaining traction in those all-important swing states. She's tied or leading in the 7 ones that everybody looks at. Arizona being tied. It looks like those Sun Belt states are up for grabs again. Nevada, Georgia. I think that even though our poll shows that voters still feel they were better off economically under former President Trump, it seems to be that Vice President Harris isn't getting the same blame for the inflation story over the past few years that President Biden was getting. So she seems to be getting a little bit of a pass on that among the voter attitudes coming through in these polls. She's taking the lead in terms of being the person to look to for personal freedoms, for example. So, it all points to this idea that her momentum is still there. She's still gathering pace. But these polls, they've tightened, but they're still pretty tight. It doesn't suggest an outright win for either candidate just yet.
And hence the narrative from them that they are the underdogs. No Democrat has won Georgia since 2008. Economically, you are an economist at heart. So tell me, the policies that are being described by the candidates, do they make sense?
Well, I suppose on the one hand, voters have more familiarity with former President Trump's policies. He's speaking a lot about the need for lower taxes. We know that he's put a lot of emphasis on the merchandise trade story with the rest of the world, Manus, wanting a ring of tariffs on goods coming to the US and, of course, taking even harsher steps on goods coming from China. So his broad outline, I think, is kind of known. Vice President Harris, the issue and the feedback from voters and analysts with her is that there needs to be more specifics. She's talking about an opportunity economy, tackling more of the issues that the middle class are facing, and some topics we've had some outlines on, which are, of course, assistance to buy a house, the assistance to bring up a young family, child tax credits, and, of course, this idea of tackling price gouging. Now, of course, there's lots of debate and discussion over what it exactly is, but that's the broad contours. Vice President Harris, she's kind of hugging the President Biden policy agenda, at least sticking to the good parts of it, but acknowledging, obviously, that a lot more needs to be done when it comes to the inflation and cost of living story. So that's a fairly tricky path for her to straddle. But there are certainly differences between both candidates. Most obvious, I think, when it comes to taxation, probably some differences in terms of foreign policy and dealing with the rest of the world when it comes to economic matters too. But for now, I think more familiarity with President Trump's, more detail needed on Vice President Harris's policy mix.
Well, we know Harris flipped on fracking. We know the Democrats have a higher tax agenda, perhaps relative to the one that Trump is putting forward. How much do we know about the detail around Trump's economic policies relative to the detail around Harris, which has been criticised as perhaps lacking?
Well, I think for former President Trump, we know it's probably a continuation of some of the themes that he's been talking about. That's deregulation. He talked about deregulating the energy sector, for example. You just heard him play that clip. He wants to have a more hawkish approach to trade. It's not clear how different Vice President Harris would be there yet, because she hasn't spoken a lot about trade policy specifically. Indeed. But we know that Trump would go hard on tariffs, for example. So there are differences in taxation and trade and on regulation.
OK, Enda, thank you so much. We'll be seeing a lot more of Enda Kern on this runway to the election. Enda Kern in Washington. Front page news, this is what are making headlines around the world. First up, more on the White House race. The New York Times reports donors to the Harris campaign are pushing her to reconsider a proposed tax on the wealthiest Americans. Investment gains on those worth more than $100 million would owe 25% tax on a combination of regular income and so-called unrealized gains. Next up, Wall Street Journal. iHeartMedia, the troubled radio and podcast broadcaster, has engaged a law firm to lead negotiations with creditors on the restructuring of $5 billion of debt. And Israel's army said it has killed 5 gunmen at the hideout in the West Bank mosque. The campaign in the West Bank kicked off on Wednesday and has been mounted in parallel to almost 11-month-old war with Hamas in Gaza. And we would like to correct a comment made by our correspondent in a report on Monday on the ceasefire talks between Hamas and Israel. In referring to the outcome of the talks, she referred to the release of Palestinian political prisoners. Prisoners are being held and may not necessarily be for political reasons and may be operatives in the conflict. Okay, on markets, we're counting down. We'll have Mike McKee around the desk. We're going to bring you some more inflation data today. University of Michigan sentiment, that's going to be critically important. Stocks are a little bit better bid this morning. We just had Kallum Pickering there talking about the propensity for a little bit more action from the Fed than perhaps the market is anticipating, but still going for a soft landing. Nvidia was the skid yesterday. The dollar has had a brutal month against all G10 currencies. Flat this morning, 12.31 is where we are. And Kallum Pickering, Peel Hunt, saying he thinks fair value on 10s is around 4%, a little bit rich in this zone at around 385. Coming up, we'll have a conversation with Janasiewicz of Natixis on why spending is shifting, not falling off a cliff. Context matters every day on Bloomberg. Good morning. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Menace Cranny. Let's set your agenda. Marching on, stocks track higher for the fourth straight month. Gains as investors await the latest inflation data. A time of deep reflection at Intel. The chip maker mulls splitting the business and scrapping projects to navigate through the historic slump. And Sunbelt up for grabs. VP Harris edges over President Trump in the swing states. More on the latest poll right here on Bloomberg. So these equities globally are marching higher for the fourth straight month. There was a little bit of a wobble yesterday in Nvidia, down 6%. I mean, more than a wobble, it was a skid. The worst day in 4 weeks. But the overall trajectory of the Mag 7 remained firm. Rotation is the name of the game, according to Franklin Templeton. We're seeing this broadening out in the reach, and SocGen concur with that, which is we're moving from this narrow bubble trade to a broader breadth. And continuing there. Bonds, 385. Kallum Pickering just with me there a short time ago from Peel Hunt saying we really are fair value at around 4%, and this looks a little bit rich. 4 months of gains, by the way, in the bond market, up 1.5% this month. Longest run of gains since 2021. Is it exhausted? We've got more data today. Bostic says that inflation remains far from the Fed's 2%. So again, just a hint of caution from Bostic. Dollar yen, keep an eye on it. And again, the dollar has had a pretty tortured sold time against the yen this month, down 3.5%, the yen rising by 3.5%, and those inflation expectations in Tokyo topping the estimates, and that lays the groundwork for another hike, potentially from the Bank of Japan in the autumn. As I say, we're closing out the week again with another slew of economic data today. What are we going to get? Core PCE, along with personal income spending at 8:30, Chicago PMI at 9:45, and University of Michigan consumer sentiment at 10 a.m. Everything you wanted to fill your bond bucket with. Mike McKee is with me around the desk. So, Mike, good morning to you. Good to see you. Again, this market is wholly obsessed about job data, perhaps a little bit less so than inflation data. Or if you look at the Doves, they're looking at the job data, not so much the inflation data. Set the table for me today.
Well, a week ago today, I was at the center of the universe because it was all about Jim Powell. And then the rest of the week, all I've heard about is NVIDIA. Now we finally get back in the game on the econ side. And it is an important but not decisive inflation number that's coming out today. The PCE index, personal consumption expenditures, and that's what the Fed uses to decide on its 2% target, whether they're meeting it or not. And they're not going to be meeting it today. Expectations are for a slight rise in the headline number, and the core will go down a little bit, but there are some who think that we may see both decline. We'll see, but it isn't going to tell you that we're at 2%. Raphael Bostic has a point there. Incomes up 0.2%. I'll get to that in just a second, but spending is what's going to be really interesting. Yesterday's GDP number suggested spending was strong in July, and the forecast that we have for the month is up 0.5%, which would be a significant increase over the last couple of months, and it's a trend that seems to be in place that Americans are continuing to spend. The question is, what are they spending? We've been hearing for such a long time about the idea that they've spent down all their pandemic savings, and there is some fear that the overall savings rate will hit a low for like the last 15 years. If that's the case, then can people keep spending? That's why it'll be important to see if wages and salaries are still going up in the incomes portion.
I suppose when you have a job and you have wages, that perpetuates the spending. But what is it that puts a floor under that spending? Is it home equity?
It could be home equity, but not for everybody, because there are not that many people who can refinance, given the fact that people's refinancing was done for years and years and years when we were in the very low ranges, and we haven't been very high. We've been very high. So until we get down more, it's not going to help a huge amount.
Okay, Mike, let's see what the data brings us. I know we've got University of Michigan as well and the inflation expectations. Obviously, the re-anchoring of those. As you said, you were at the center of the universe last week. We'll take you back to the center of the universe later today with the data. Mike will be with the surveillance team. My guest this morning is Jack Janasiewicz of Natixis, and he writes this: the Powell put is back, and this strike price is rising. It has always been a put on a labor market conditions, not equity market prices, and that remains true. Jack, good morning to you. Mike and I just talking about the consumer there, but this Powell put on the labor market, what is it that triggers a deeper series of cuts in this job market? How bad does it have to get to deliver fast and furious cuts? Good morning.
Good morning, and thanks for having me on. You know, I think it all comes back down to that employment side of the dual mandate from the Fed. I think the Fed basically came out and told us at the last meeting here that, you know, inflation was moving comfortably towards the 2% target, and now the risk was coming on the employment side, which is full employment. So paying attention to the unemployment rate, we still have a couple more jobs prints between now and that first September cut. And I think if we get a market deceleration in that payroll number, you might see the potential for that 50 basis point cut increasing. But I think for now, we're still in the camp that you're going to get a series of consecutive 25 basis point cuts.
Mike and I were just talking about the consumer. That's where our conversation finished off. You have faith in the consumer, although I would challenge that and say you've got a bifurcation in the consumer.
And I completely agree with both of those comments there. You know, you made the comment earlier, simply if we have a job, you're earning a real wage and inflation's falling, so real wages are on the rise in your working hours, you're going to have a comfortable income. And what do we do in the United States here? We're pretty good at spending that income. So, you know, from that perspective, the consumer is certainly supportive, but we are certainly seeing different echelons of that consumer income basket starting to get pinched. And more specifically, that lower basket's really, I think, starting to get pinched a bit.
Look, one of the things that I am tracking is the release from home equity. As Mike said, look, man, it's not everybody has a home and not everybody can tap a home equity line, but it's up 20% since 2021. How much of a pillar of strength is that for the upper end of the consumer?
Yeah, I think that certainly comes into play here. If you think about where housing prices have gone over the last couple of years, you know, we're certainly pushing at all-time highs, which means there's certainly plenty of equity to tap into. But again, some of the numbers that we've seen, it's on the rise. But that sort of capacity utilization, if you will, there's still a big buffer there. So to us, that tells us, yeah, we're at the early stages of that being tapped, but still plenty of other areas there which they can draw from, which could continue to support big ticket consumption going forward.
Look, this is an economy which is robust. Look at the GDP revision yesterday. Look at the jobless numbers. This is not an economy at the moment that looks as if it's going to crash or have any kind of a hard landing, is it? It's the jobless claims and the NFP that are going to be the absolute bell ringers here.
Yeah, and if you look at those GDP revisions from yesterday, you know, the parts that we want to look at, that we want to see strength, those are basically all revised higher. And those real final private domestic sales, that's the key for us, because it basically strips out exports, it strips out the impact from inventory restocking and government spending. That was revised higher. And that tends to be a pretty good indicator of upcoming economic momentum. And that's still pointing close to 3%, which means, you know, the economy is still doing very good in here. And I think that's expected to continue.
And those banks are flying higher on that as well, aren't they? Credit spreads remain well behaved. The bank market is on fire. And this is all part of the risk-on narrative.
And I think the other thing that we're hearing from some of the pushback we're getting, you're seeing a little bit more of the rotation in the marketplace. And defenses have been doing a little bit better. But when we look at other places within the market, like you just mentioned, credit spreads, they actually are continuing to drift back towards the recent tights. You look at financials performing a little bit better than the broader market. So, you know, even though the narrative might be shifting towards a broader participation with defenses picking up, I'm not necessarily sure that that's a bad thing. We're not seeing any sort of, I think, concerns coming out of the credit markets. And that's telling us quite a bit that things are still in good shape.
Look, we have moments of existential angst, like NVIDIA yesterday, down 6%, worst day in 4 weeks. But then I look at commentary from other houses. Industrials and energy don't need moonshots to really sustain. So are you a believer in the breadth? A lot of people have talked about that to me.
Sure, and I think the key for us was, one, confidence that the cutting cycle would be commencing, and I think we certainly got the green light from Powell on that at the last meeting. I think the other one is simply going to be, are we getting a more of a growth slowdown or an actual recession, a soft patch recession? You know, we're in the camp that this is a soft patch. Starting points matter. We're slowing from an extremely higher level. And when we start to slow, we're basically slowing back to long-term trend. And I think once there's confidence that we're not going to be slipping into the recession here, I think you're going to continue to see that breadth widening out, probably more aggressively.
Where would you be inclined to look at bond markets? 385, 4 months of a rally, day after day, people come on the show and they say it's looking rich, but it's also a decent hedge, isn't it?
Yeah, and that's the good thing that we're seeing. I think from a fair value perspective, we think right around 385 for the 10-year is probably about what we would consider to be priced properly. So we're basically at that level here. But, you know, when we start to think about that correlation, that equity risk offset in the traditional 60-40 portfolio, we're finally starting to see that inverse correlation coming back into play. And so from your perspective, you know, that inverse correlation is certainly going to give you that equity risk offset, as well as throwing off some yield at the same time. So the fixed income portfolio back in terms of what it normally had done from a historical perspective, and that's a good thing for investors.
Yeah, and that 60-40 portfolio, we've seen it, you know, come back from the dead and perform pretty amazing records recently. There you go. Jack, thank you so much for being with us. Jack Janasiewicz of Natixis. Coming up, Intel pushing higher. It's weighing the options, including splitting the business up. Context matters from Bloomberg. Good morning. It's Bloomberg Brief. I'm Manus Cranny in New York. Intel stock is gaining pre-market. The chip maker is said to be exploring options to navigate probably the most difficult time in the firm's history. What is the option for Pat Gelsinger? Robert Lee is senior analyst for Bloomberg Intelligence. Robert, look, Intel is in a really tricky spot. They had a brutal reporting day a few weeks ago. Gelsinger's under pressure. What are the strategic options, the best ones?
Okay, well, Intel follows a very traditional model within the semiconductor industry, referred to as IDM, or integrated device manufacturer. Does everything from designing the chips, from fabricating the chips, from packaging and testing them, and then distributing them. But that's a very cost-heavy model, as you can imagine. You compare and contrast with like NVIDIA, who solely specialize in design, or TSMC in Taiwan, who solely specialize in fabrication. So I think as a cost of maintaining this very broad-based model increase, it makes sense to look at ways to free up cost and free up capital so they can maybe invest in other areas. Their second challenge is, you know, they're very dominant in the server and PC markets, but those are very mature. They're not growing, or not growing at a considerable rate. So again, to try and relieve some of the cost burden, maybe potentially spin off the foundry business, which is loss-making, could free up capital to invest in higher growth areas, particularly AI, to state the obvious.
Yeah, to state the obvious. Is it that just Gelsinger chose the wrong horse to back? I mean, he is his own biggest customer in the foundry business. They've never really managed to reach scale. Is it just because it's so competitive?
Yeah, I mean, for those with a long enough memory, Intel has tried to diversify into other markets for the best part of 20 years. They made a major effort to move into mobile phones. That didn't really pay off for them, you know, 15, 20 years ago. They tried to push into foundry as well, but as I've said, and we all know, that's dominated by the Taiwanese and TSMC. Intel was, until several years ago, the technology leader in the industry, but again, unfortunately for them, they've been overtaken by TSMC, and as we've seen from the hundreds of dollars that one single piece of equipment costs from ASML, it's an extremely capitally intensive and expensive business to maintain. So I think, Intel is thinly stretched. It's got great IP, it's got great engineers, but it needs to decide where it can add most value add and generate the best return and profit for investors. So potentially splitting up the business is one option for them, because trying to maintain this integrated model is, again, increasingly expensive. Just one brief number for you. Intel's headcount, as at the end of last year, was more than the combined headcount of TSMC and NVIDIA together. Wow. So again, it's a very cost-intensive model, which perhaps doesn't make the most sense, looking forward and in the current operating environment, which is why they announced a 15% reduction in their headcount earlier this month.
Here's the single question. Let's just finish off with this. Do you think that there's going to be an appetite if he puts the foundry business on the block or up for sale? Do you think there'd be avid buyers?
That is a really good question. You look around the world, areas like Singapore have tried over a longer period of time to make it in foundry without any huge success. You've got many of the Gulf states, again, with big ambitions in semiconductor and AI. So, as they say, everything has a price. Whether there is a willing buyer in those areas or from those areas remains to be seen. But I mean, semiconductors dominates the conversation across the board these days, doesn't it? Everything ultimately in the world we live in relies on chips. So again, there is still good IP there. They may not be ranked #1, but they're still one of the leading players globally. At the right price, I think there would be demand for that foundry business, yes.
Okay, Robert, let's see what the strategy options that he lays out. He certainly admitted at the Deutsche Bank conference that it had been a tough couple of weeks. Robert Lee there. On the Intel story, let's turn our attention back to Washington. We are 66 days away from the US general election. Vice President Kamala Harris joined Tim Walz in an interview on CNN. Let's take a listen.
My agenda includes what we need to do to bring down the price of groceries. For example, dealing with an issue like price gouging. What we need to do to extend the child tax credit to help young families be able to take care of their children in their most formative years. What we need to do to bring down the cost of housing.
Meanwhile, former President Donald Trump has a different focus if he wins.
The first thing I will do to make middle-class life dramatically more affordable is to end Kamala's war on American energy, terminate her Green New Scam, and drill, baby drill. We're going to drill, baby drill.
Well, the latest Bloomberg Morning Consult poll shows that Harris is edging her Republican rival in swing states, maintaining the momentum after the DNC. Excuse me. Andy Curran joins me to go through this poll. And look, this is a progression of the halo effect. And these Sun states, as they are known from Georgia and North Carolina, they are very much in play, and she is making progress.
Yes, it does seem Vice President Harris' momentum is continuing. Manus, the poll shows that she's now tied or leading in 7 of these all-important famous swing states. The likes of Nevada and Georgia back in play. They had seemed out of reach when President Biden was the candidate. Arizona still tied with former President Trump. But it speaks to the idea that Vice President Harris' message is cutting through. Interestingly, in our poll, voters suggest that they still feel they were better off economically under President Trump. But nonetheless, Vice President Harris has narrowed that lead. She doesn't seem to be getting the same blame that President Biden was getting for the inflation story here over the past couple of years. So she's getting a bit of a pass on that side of things. She's also looked to more favourably on issues like personal freedom, for example. So by all accounts, it does suggest she's cutting through. Now, these polls, however, it should be said, are still pretty tight. Some are within the margin of error. It doesn't really give a clear lead to either candidate. But it certainly suggests that the race is tight. It shows that the economy is at the centre of it, and Vice President Harris has made some inroads into former President Trump's lead on that side of things.
We're getting indications on their economic agenda, both sides. One is on tax, one is on housing, a change in direction from Harris on fracking. As you look at the economic agenda, what sense do you make of that?
Well, I think former President Trump's agenda is probably broadly known. That is, it's deregulation, as he just spoke about there. On the energy front, for example, it's about bringing down taxes, extending those tax cuts that are due to expire next year. It's a fairly aggressive approach on the merchandise trade front with the rest of the world through the form of tariffs, in particular, of course, with China. So we kind of know the contours there. Vice President Harris has made some detail in terms of what she would tackle. She's talking about the opportunity economy, tackling middle-class issues, and that is, as you mentioned, this idea of going after price gougers, offering help for home buyers, offering tax credits, child tax credits for families. The issue, though, is, a lot of analysts are making the point that these are light on details, light on specifics. In the interview last night on CNN, there was, again, some commentary around, tackling these issues that are impacting the middle class, but it wasn't it wasn't very heavy on detail, and that's what a lot of people are looking to. Vice President Harris is trying to hug the Biden agenda on the one hand, the successful parts of it, which has clearly been a very strong recovery over the past few years, but of course she's also acknowledging that on the inflation front, for example, a lot more needs to be done. So it's a pretty tricky path that she's trying to navigate there.
She is, and I mean, some of the differentials, you just heard former President Trump talking about drill, baby drill. Kamala Harris obviously changes her view on fracking. When it comes to the economic policies of Trump, obviously his narrative is about lower taxation and at the same time going after the middle class. On his economic policies that you've seen or that you've heard from, what do you make of those?
Well, by all accounts, they are cutting through, because voters, according to our own polls, still feel they were better off under President Trump's administration. That, of course, was because it more or less predated the big inflation outbreak over the past few years. And again, he's promising another agenda of lower taxes for both workers, households, and for businesses. And of course, he's talking about bringing down regulation, the cost of doing business, and rejigging manufacturing here and taking a more aggressive approach to doing trade with the rest of the world. So there are a lot of messages and populist strains in that clearly resonate with the broader voter base. And this is why Vice President Harris, too, has moved on some of these areas. For example, she's matched his pledge, no tax on tips, for instance. You mentioned the fracking ban. Vice President Harris has moved into some of these areas as well. We don't quite know specifics of where she is on the trade story yet when it comes to tariffs. She has talked about President Trump promising a tax on consumers, maybe hinting a different approach there. But clearly there are differences between both, but there are areas where both are also sharing commonality to try and share that populist message to the voters.
Enda, thank you very much. We'll see a lot more of you between now and the run-up to this election. That's Enda Curran on the very latest polls and economic narratives. Coming up, big day for economic data. I'll run you through the very definition of a calendar right here on Bloomberg. Slew of economic data is to hit the tape today. This is how the rest of your agenda looks. At 8:30 a.m. it is about the PCE, the core PCE and personal income numbers. Then you've got the Chicago PMIs at 9:45 a little bit later, and UMich sentiment numbers along with the inflation outlook for 1 year and 5 year. Some micro movers to keep an eye on through the day. Dell, as we've been saying, the gains there as the results came through. Strong AI demand for servers there. Sales topping estimates. Marvel Technology, you've got, again, a nice bid there. Higher as AI demand fuels their earnings growth. And then Ultra Beauty, that dips. The retailer cuts its sales outlook, slowing consumer demand. Price target lowered by Piper Sandler and Canaccord. The bond market had a little bit of a pop yesterday as you saw that revision in the GDP and some strong consumer data. What you're looking at here is the past 5 days, and Bank of America talk about the flows into bonds. Let's see, the data could shift the dial.